If you had bought a single share of Vedanta Limited back in June 2020 at around 105 rupees, you would have received over 229 rupees in dividends alone. And today, that same share trades at over 435 rupees. Despite these strong returns, investor sentiment around Vedanta remains divided. The biggest reason? It's debt. As of Q4 FY25, Vedanta's consolidated debt stood at 53,251 crores, and that's after multiple attempts to restructure and deleverage the business. However, the real pressure comes from its parent company, UK-based Vedanta Resources Limited, which funds Vedanta Limited. VRL raises billions of dollars every few years, primarily to repay previous bonds, often at higher interest rates. So why, despite the financial strain, does Vedanta Limited continue to pay out some of the highest dividends in Indian corporate history? Let's break it down. Welcome to Bottomline by Groww. In today's episode, let's analyze why Vedanta Limited pays high dividends, examine the risk it faces, and explore its strategic initiatives under Vedanta 2.0. First, let's try to understand Vedanta's business. Vedanta is one of the world's most diversified natural resources companies with operations in India, South Africa, and Namibia. Its business spans zinc, lead and silver, aluminium, iron ore and steel, oil and gas, power, and nickel. It owns 63.4% stake in Hindustan Zinc Limited, 51% in Bharat Aluminium, and controls multiple divisions like Sterlite Copper, Sessagoa Iron Ore, Cairn Oil and Gas, and more. As of FY25, 56.38% of Vedanta Limited is owned by Vedanta Resources, the promoter entity. What one should know about Vedanta is that it is a commodity player. That means it's in a cyclical business as prices fluctuate in response to economic activities globally. And the same is reflected in the stock price movement. So Vedanta's profits rise and fall with global economic cycles. Despite this volatility, one thing that has remained consistent: dividends. What began as modest dividend payout of just 20% of net profits in FY05, the company has increased the dividends exponentially to as high as 357% in FY23 and 259% in FY24. Vedanta has paid over 1.12 lakh crore in dividends over the last 6 financial years. FY23 alone saw the highest ever dividend paid by any Indian company in a single financial year. This is a good thing, right? It seems like a massive win for shareholders. But it comes with a catch. First, VRL, chaired by Anil Agarwal and based in the UK, is the parent company that owns a 56.38% stake in Vedanta Limited. VRL's primary source of income comes from dividends and brand fees paid by VDL. Ironically, while VDL maintains a sizable cash reserve on its books, VRL can't access it directly, even though a large portion of VDL's debt is actually owed to VRL. Over the last few years, VRL has tried multiple restructuring strategies to unlock this cash. In FY20, VRL tried to delist Vedanta and unlock reserves worth 54,263 crores, but failed due to lack of shareholder acceptance. And because the delisting failed, the only route for VRL was through dividends. Since then, dividend payouts have become VRL's lifeline. About 55 to 60% of Vedanta's total dividends go to the promoter group. All these dividend payouts reduce the equity capital reserves that Vedanta had built from accumulating years of profits. Second, the situation becomes more concerning when you compare dividends paid versus total debt. Vedanta is burdened with substantial debt and has major capital expenditure commitments ahead. Its aggressive dividend payouts are increasingly seen as a strain on its financial flexibility, potentially undermining its ability to sustain operations and fund future growth. In FY23 alone, Vedanta's total debt stood at 80,329 crores, yet it still paid out a little over 41,000 crores in dividends. That naturally raises a key question. Why wasn't a larger portion of that cash used to bring down the company's debt instead? In the last 4 fiscal years, Vedanta's debt-to-equity ratio climbed sharply before beginning to ease. In FY24, the ratio peaked at 1.71 times, as continued high payouts and ongoing capital expenditures kept net debt elevated. However, in FY25, the company began scaling back dividend payouts and using more cash for debt repayment, a sign of tightening discipline. Accordingly, Vedanta Resources, the parent company, has reduced its debt by over $4 billion in the past 3 years. And Vedanta remains firm on its deleveraging plans going forward. This is all part of its big pivot, Vedanta 2.0. It aims to transform the group into a $100 billion market capitalization by prioritizing deleveraging, optimizing its portfolio, and driving sustained operational performance. Vedanta announced a major restructuring, demerging into 5 independent listed entities. 1. Vedanta Aluminium, 2. Vedanta Oil and Gas, 3. Vedanta Power, 4. Vedanta Steel and Ferrous Materials, and 5. Vedanta Ltd, which will retain Hindustan Zinc, Zinc International and Investments. For every Vedanta share owned, investors will receive 1 share in each of the demerged entities. But what's curious is that over the past decade, the Vedanta Group focused on simplifying its corporate structure, successfully consolidating its various businesses from metals to oil under a single listed entity by 2012. Now Anil Agarwal is charting a new course, effectively undoing that consolidation. The reason? Much like before, the goal is to unlock greater value for shareholders. However, the success of the 2.0 plan depends on 2 things. 1. How Vedanta allocates its existing debt across the 6 entities, and 2. What valuations will the market assign to each of these demerged units? Without clear details on these points, uncertainty remains about true value creation. Also, this isn't the first time Vedanta has considered such a demerger. In 2021, it announced a similar plan but later shelved it. That history has made analysts and investors cautious about the actual execution. Amid all these strategic plans, one major red flag still stands out. Nearly 100% of the promoters' shares are pledged. This means that if Vedanta's stock price were to fall significantly, lenders would be forced to offload those shares in the open market, triggering further declines. Any such liquidation would not only drag the share price down, but also dilute the promoter's ownership and control, heightening both financial and governance risks. So what should an investor understand from all this? Well, Vedanta has outlined $1.5 to $1.7 billion in capex for FY26, mostly across its aluminium and oil and gas verticals. Vedanta has also committed to reducing its debt by $3.5 billion over 3 years. The company expects India's economy projected to grow at 9 to 10% in FY25-26 to drive commodity demand and support free cash flows. But that brings us to valuation. Vedanta's current price-to-book ratio is over 4.1 times, much higher than the median price-to-book of 1.4 times. This reflects high expectations from the company's 2.0 plan. But if any of these stumble, be it commodity prices, project delays, or poor demerger execution, the valuation could face serious pressure. So, can Vedanta deliver? Or will the debt continue to haunt the company's future? Share your thoughts in the comments section, and for more such insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.